Hello, my name is John Novak. I'm the developer of the T3 Fibs Pro Trader Fibonacci software. And in this lesson, we're going to talk about tops and bottoms in trading from the edges. What we're going to do first is we're just going to go through a couple of quick concepts. We're going to talk about Fibonacci tops and bottoms, and we're going to talk about breakouts. And depending on the configuration of our indicators, you're going to classify each top and bottom as either strong or weak. And the Fibonacci based areas in our software may reverse the market. Those areas are going to be called termination conditions. If one of those areas actually causes a strong reversal, then the market generally gives us a higher probability winning percentage on our trend trades, and as well as a larger profit potential. Whenever we classify a top or bottom as weak, and we'll get into that in some slides here, generally it's going to generate smaller profits on trend trades, and the trades that you do will have to be managed more assertively. Also, when we do breakouts of these termination Fibonacci areas, it's going to create opportunities to continue trading in the direction of the established trend. So what we want you to do as a user of our software is always start your chart analysis with a prior, maybe two prior tops and bottoms, and it's going to help you build a contextual relationship with the chart, so you'll be able to know what to do in every situation. Really quick, you're going to see this a trillion times, but what we're going to be waiting for, and I want to talk about it first, is a strong crossing of our triggers with what we call an odds favorable momentum look. And again, I'm going to pull up my pointer here. And what we're talking about is our small triggers are going to be crossed up in green, and they're going to physically be above the large triggers, which are crossed up in green, that are wide or widening. And this is going to give us the odds favorable trigger line look and momentum that we need to do very profitable, very high probability trend trades. The same thing is true in reverse. When the market's going down, we want these small triggers wide and widening below the large triggers. We're going to get odds favorable momentum to make the market go down. And when the trigger lines, small trigger lines, are inside, physically inside, so the two smaller solid triggers are inside the dotted triggers, anything can happen. And this is where the understanding of where you're coming from and where you're going to go is very important. So what we're going to start off with first is what we call a great top, great bottom, strong top, strong bottom. You'll hear, those two terms kind of interchanged as you get to the educational material. So a strong area is represented by a reversal of the trigger lines from the Fibonacci area. So I'm going to point down here at the bottom at 1041, and what we're going to be looking for is price to touch Fibonacci without the trigger lines getting below the Fibonacci, and this is a Fibonacci area that may hold. That's what we call termination conditions. When we call it a strong bottom, that's only after both of the trigger lines have rolled up right here. So we don't know it's going to be a great bottom. We just know it's an area that we have to pay attention to, right? It's an area we have to stop going short, let's say, since it's support. And if that support holds and the triggers roll, we're going to label this as a strong bottom. Now, the same thing holds true. You'll see this all day long, every day on every chart. You'll see fibs hold, you'll see triggers roll, you'll be able to say it's a good bottom. We also are going to deal with breakouts, right? So when we talk about breakouts of areas with strong triggers, what we're talking about is this red Fibonacci area right here, maybe even prior divergence lines. And what we're doing when we get to these areas is we're going to look at, number one, where did we come from? So if we have a good bottom at the bottom, that's advantageous. And then strong triggers generally will break Fibonacci areas after a good bottom. So not only do we want to trade after the good bottom and the trigger lines roll, but we also want to trade breakouts of any resistance as long as the trigger lines remain strong. And we'll continue to do trades in the direction of the trend. So we have strong areas, we have breakouts of areas, and then we have our third classification, which you're going to see a lot, which is the market just turning down for no good reason, right? There are reasons, but it doesn't matter what the reasons are. It just matters that for us, where did it turn from? And when the turn of the pullback or retracement in price is not caused by a Fibonacci area, we're going to label it for our purposes as a weak top. And that's all I really want you to know right now, but I can't really leave you hanging. So I wrote in the second half of it, which is generally after a weak top, you can anticipate the mid bands and fibs will give you a good bottom, and we're going to try to take trades from this area to get the rest of our move. And the only way we're going to do this confidently is that we are able to classify this top as weak. We'll get into a lot more on that in just a moment. So to summarize, Fibonacci tops and bottoms are breakouts. What we're going to be looking for as traders are strong reversals from the Fibonacci based indicators to create high probability trend trades. For new users, really the first 30 days and probably beyond, probably for the first 3 to 6 months, we want you to really focus on the 5-1 trend trades that happen after a strong top or bottom or breakout with strong trigger lines. Once you have mastered those really high probability trades, the entries, as well as the management of those trades, then you can start to add on additional entry techniques and add in different charts. And we'll take a look at some examples of that. So the key takeaway for you is you're always going to start your chart reading and your chart analysis from a prior top or bottom. And again, I said it before, but it bears repeating. This will help you build your contextual relationship with the chart. You'll know what the charts are telling you, and you know what should happen based on what the markets are saying with the indicators. So defining this strong or weak top or weak bottom or strong top or strong bottom is going to help you achieve proper entry and exit management techniques for each type of trade. So when we talk about a trade, again, this is where we start everybody out at. You don't have to stay here, but this is where the education is going to start. And when you read our trend trade rules, you'll start to see all of these things overlapping. After a breakout of fibs or a new top or bottom with strong trigger lines, we're going to look for trend trades. And that's what we look for on our 13-2 chart. We're also, rule number 2 says don't trade into an area that might hold, right? That's what we call a termination condition. And then obviously we talk about entries later. So let's take apart, this is the training material, and trigger line configurations are going to be rule number 1. And rule number 1 says good top or bottom, and then strong trigger lines. So when you look at this in the user guide, you'll start to see, where we draw these circles or pullbacks that are potential trades on our smaller charts. And that's it. Rule number 2 is, again, from the manual, so you kind of know where this plays out. Rule number 2 is don't trade into a termination condition. And let's pull up this slide. Let's take a look at the termination conditions. And I want you to really grasp this concept because this is very important. A termination condition is the Fibonacci based indicators that may reverse the market. So not that they will or not that they have, but they may. So we have blue fib supports, red resistances, yellow 1-to-1 dots, cyan divergence lows and highs. Third divergences in the same area, maybe even the large sharp mid bands. when reached if the prior pivot was weak. And we won't get too far into this, but again, if you hit a line, it may cause a reversal. So you have to have an understanding of what the market is telling you. Then you're going to take that information and you're going to determine entries, right? So rule number 1, strong triggers. Rule number 2, don't trade into anything. Rule number 3, find your entries on your smaller charts. And again, when we talk about this, I'll just blow this up for you out of the user guide. This is your trading plan for your first 30 days and beyond. Strong top or bottom, plus strong triggers on your 13-2 chart, plus no termination conditions, also known as room to your targets on your 13-2 chart, and then entry area at the triggers and fibs on your small chart. And that's going to be your trade setup. So, again, I just wanted to kind of summarize where you're going to end up with trade setups by reading the tops and bottoms of the market successfully. Now, you'll see this in our user guide. And again, I think it's so important to be consistent, to be a winner, and more importantly, just not to be totally overwhelmed by how much information the market presents it on the charts and how many indicators and twists and turns. And this really will help you focus on the highest probability, most important things. And that's really what we want for your first 30 days and really beyond until you get really comfortable with this concept. We want you to say for the first 30 days, I'm going to only do trend trades. I'm going to follow the rules, and I'm going to give myself the best chance to be successful. So watch, once you have this down, the trades are going to jump right off the charts to you. So let's take a look at a chart. And again, as a new user, you look at this and you're like, okay, what do I do? Right? What am I supposed to do? And this is where the focus of the prior bottom is going to give you the answer, or the prior top. In this case, it's the prior bottom. The yellow dots is one of our termination conditions. We call them one-to-ones, right? So if we have one-to-ones in divergence, that's a termination condition. And after the trigger lines roll, it's a strong bottom. So again, we don't know it's going to be a strong bottom at the bottom. We have a hint because we've seen it a lot of times, but we don't know. So I don't want you to think you're trying to go long down here at the bottom. That's not what it's about. It's waiting for the Fibonacci area to hold, waiting for the trigger lines to be wide and widening and strong and odds favorable, so you can take a little pullback on your 5-1 chart and get a trend trade long and make some money. And again, we always say, trading the market is 90% chart reading. So again, at 1424, you had to wait a whopping, 5 or 6 minutes for your trade. That's not too bad. The markets have been really generous with wait times in between trades for us. Let's look at another chart. Another condition for us that will generate a good top, right, is Fibonacci resistance. And look, Fibonacci resistance is great, but if the trigger lines don't roll, it's not a great top. And if the market rolls, but it's not from Fibonacci, it's not really a great top. And then if it's not a great top, the mid-band can be a termination condition on a larger chart, which makes the market go back up. And then eventually, I say eventually, it took 30 minutes or so, 30, 40 minutes. Eventually, we get a second divergence that's lower than the first, which is one of our strong chart conditions. So this Fibonacci resistance eventually generates a lower divergence, and it's still not a great top. Only after you have the second lower divergence and you have strong triggers do we have a great top in place, or a strong top. This is the trade you're going to be doing as a new user, with strong triggers, a great top, nothing in the way to the first target, and you're going to go short, somewhere over here, and you're going to make 20, 30, 40 ticks on crude oil. And you're going to reach your goals and objectives. So let's take a look at that chart that we looked at in the beginning. Fibonacci holds, right? Not until the triggers roll do we start looking for the trend trade long. So we'll buy a pullback. You can see this little tail kind of represents a pullback on a smaller chart. You can't see it here, but conceptually, fibs hold, triggers roll, nothing in the way, you're going to do a trade. Triggers are still strong, you get a pullback, you're going to do another trade. You didn't get to your target, you might get one more trade. So you can see the amount of money from this area where the trigger lines have rolled up to Fibonacci resistance represents, $900 on one contract, which is over twice, 2.5 times the daily goal almost. So it doesn't take a lot of trades. It takes high probability trades for you to be successful. As we look at this breakout chart, same thing, fibs, breakout, you're going to get a trade at Fibonacci support. And, before it hit the first resistance, that's $400 right there, from there to there. And I don't know the time scale. It might have taken 3 whole minutes, 4 minutes. The markets have been pretty quick. That's crude oil. So, again, at some point, it's not just the big chart. You have to have the large chart first, and then you have to go to your smaller chart to find trades. So, this is a very typical situation. You may have what looks like one more long trade, but it might be into resistance that might hold, right? So this is kind of what we say when we say don't take trades into a termination area. Instead, wait for the termination to hold on the larger chart, the triggers to roll on the larger chart, and then we're looking for the entry short. And then same thing in reverse. If, let's just say hypothetically, the 13.2 chart is a good bottom and the triggers roll, and the 5.1 chart has a good bottom and the triggers roll, we're going to look for trades going the other way. Pretty straightforward concepts. One of the things that's in the trigger line configuration section that people initially have a little hard time with, because again, let me blow up this picture right here. The concept is when the triggers are inside of each other, can I still take a trade? So, understanding whether or not you have a great top is very important for taking trend trades. And again, these are pretty easy looks, right? Super strong, you're going to go short. Once the triggers get inside of each other, you can still take trades with the trend as long as you haven't reached the ultimate target. Now I'm going to add one more wrinkle to that. As long as the 5.1 chart says you can take a trade and the 5.1 chart doesn't have a termination condition. Because if the 5.1 chart has a termination condition, then it's probably not going to be your trade. If it doesn't, you're going to take a trade. We'll get into that just a little bit more as we start looking at another concept. Knowing whether you have a strong top, strong bottom is going to be very instrumental in your management, not only your entries and your exits. So let's take a look at, you've seen this picture. We started off with this, right? When we were defining a weak top in the market, right? So a turn from nowhere with no lines, and we said, there's a chance that the fibs and or mid bands are going to hold and that the market generally will continue to the long side, which is great, but you're not going to get a 5.1 trend trade, because look, the concept is, for a trend trade, you want all of your triggers going up, right? So this type of configuration going up, you're not going to get that here. And because the triggers are so far away, you're not going to get all of them rolling up until the market's gone so far from this area that it's, it's nice to know it, but how do I get into it? So we have a section in our profit targets, trade management, and entries, and we'll get into, how we're going to deal with this. Let's deal with management first, okay? From the management section, right? There's a lot of talk of divergence, second lower divergences, second higher divergences, three divergences. And, when we talk about three divergences, I'm talking about, 1, 2, 3 from the same area makes the trend reverse. 1, 2, 3 from the same area, especially with the second or third one lower, makes the market reverse. So that's in the termination section as well as the management section. All of these things, these concepts overlap with each other considerably. So in the management section, if you have a weak top and you have a lower divergence, you have to get out. Or if you have a potential weak bottom and you have a higher divergence, you're going to have to get out. If you have a weak top and you have a third divergence, you're going to have to get out. So when we look at this chart, right, we're not looking, you can't see it on the 13-2 chart by itself. So this is where, the triggers get weak and you have a lower divergence on your 5-1 chart. That will be the exit to your trend trade long. However, we don't want to give up on the whole market altogether because remember we said maybe the fibs and midbands hold so we can go back up. So again, the management from the 5-1 chart here and the lack of Fibonacci areas here tell us to get out, number one, on the small chart, and number two, tell us this is a weak top. So it sets us up for what's going to happen down here. And when you get through the material and you get into additional trade entry techniques and things like that, we talk about, maybe having a larger chart like a 21-3 chart to see how strong the trend is, or we also talk a lot about continuation trades. So if we have a strong 21-3 chart, if you use one, and you make it back to the midband, and it's a weak bottom, you can start doing continuation trades. And let me give you a simplified version. This chart on the left is our 13-2 chart, our larger chart. Again, this is not the same picture that we saw in the prior example when we're defining a weak top. This is one that we had in class that we had talked about. But it's the same concept, a pivot not from a Fibonacci area. That's our weak top. And with that weak top, we start to anticipate that maybe the midbands and fibs are going to hold. So we want to get paid, right? Remember, we already discussed this. If we have to wait for all the triggers to roll, it's too darn late. So because we have a weak top and we have a really good area that probably will hold, we can go to the smaller chart and we can find any entry back to an area and or the, after the small triggers roll over. And, short version is you're buying a pullback to the small triggers after they roll over with a stop below the low, anticipating that this area on your 13-2 chart is going to hold because you had a weak top prior to the low. And if you don't have the contextual relationship with your chart, knowing that this top is weak, you're not going to be as confident taking a trade when your small chart's red and the triggers are down and it looks very scary. Right? So again, it's really important to have this relationship prior to taking these types of trades. I added this chart in just for fun. This concept is universal. This was Ethereum, I don't know, maybe back when it was at 3,000, it was at 900 this morning. So we've gone down quite a ways from here, but it's the same concept, same idea, and you can use any chart, any market. Triggers are below, you're going to do a trend trade short. The management of our trend trades with a higher divergence is going to take you out of that trade without losing. The market's going to reach probably the 13 midband and edge of fibs. And then if the small triggers roll over, you're going to go short, and you're going to get the rest of your money. So that continuation style trade is a wonderful trade to get the rest of your trend trade that just for whatever reason, made a weak bottom and they had to go a little bit higher. I always like to call it they needed a running head start at the top or bottom. Now, inevitably, traders are going to say, but John, can't we trade back to the mid-bands and fibs? And the answer is yes. I'm going to add a wrinkle because without divergence on the 13-2 chart, you probably won't get a short trade back to the mid-bands and fibs. If you have divergence and the small triggers roll below the large triggers, I'd say 75 to 80% of the time it makes it back to the mid-band and fib area. You at least get one winning trade out of it. So if you are at a weak top that doesn't have any areas and it has divergence, which you have to have at least a couple bars down for this divergence to be true, which would also make your triggers roll, then you can try to take advantage of it. And again, you can go back and study this, but it's really, really, really consistent. And I want you, again, to see the difference. Here we have no divergence and no short trade before we get to the fibs. And then we end up going long. In the example I'm talking about, and again, I don't want you doing this as a new user, but I want you to know where you're going to get extra trades as the market, as your experience continues. Divergence from a high from nowhere almost always gets you back to the mid-band and fib, so you can take a trade or two to get there if there's enough space. Then when we get there, because it's a weak top that didn't happen from any type of Fibonacci area, you can now look for continuation long rules to get the rest of your long trade. So in essence, you're double dipping on the market, trying to get trend trade longs, recognizing management conditions to get out, being able to get short with divergence, knowing that you should get back to here. When you get back to here, you know that because we had a weak top, not from areas, you can look for continuation trade longs. If the area holds and you get a continuation long, and then the triggers roll, you can continue going long with trend trades. So everything that we do is interconnected. One of the other things that we talk about a lot in management, I want you to think about this one statement. You cannot see change coming using only one chart. Because a lot of people say, in the beginning, they say, well, why don't I just trade one chart and wait for fibs to hold, and then I don't have to watch a small chart. And again, maybe you could get away with it, but you would lose a lot of the ability to manage your trades that don't follow through. And what I mean by that is, again, this is a fib and a breakout of a fib, which is going to create long trend trades for you, right? So again, you're going long, going long, going long. And then eventually you have 2, 3, 4, 5 divergences on the smaller chart, just really telling you that the party's over, as well as the small triggers getting below all of the large triggers, really saying it's over. And then you end up getting this extra divergence, and look at your trigger lines at this point. This is where we stop doing trend trades, generally when the entry areas are below the large triggers. Sometimes people will do one more, but you really have to be on your toes here with these termination conditions once the triggers roll, because it will make the market go back down generally. And, sometimes when the 5-1 chart kills the trend, which happens a lot, you're going to anticipate that the mid-bands and fibs are going to hold, right? We just went through a lesson on that, didn't we? And again, just because you anticipate that they might hold, they don't always hold. So you don't always get a continuation trade like the one we were talking about, right? This one, where weak top, fibs hold, you get a continuation trade. You don't always get a continuation trade. So, you know, while we're looking at this and we say there may be a continuation trade, if the small chart doesn't cooperate, we don't jump in front of anything that's wrong. So again, just to kind of back out from that picture just a little bit, and you'll start to see how strong tops, weak bottoms, strong bottoms, all of these things will give you extra confidence in your read of the market. So I'll start from the bottom down here, okay? Because I want you to do your analysis from what happened and then work your way forward. It makes it a lot easier. What happened? We had fibs. Great. After the trigger lines rolled, we had a great bottom, strong bottom, right? So if there's trend trade longs, we'll do trend trade longs, and there probably was. At some point, we have a pivot from nowhere. No lines, no fibs, no nothing. So we're going to say, cool, we'll do continuation trades. And like I said, sometimes they come, sometimes they don't. And if they don't, we'll end up going lower. And then we get to a termination condition, which is a blue fib, but the triggers roll to the upside, right? It holds. And this isn't our long, again, we're just reading our charts and we say great bottom, weak top, no continuation, but we get a higher divergence than the last one, which means that's again, a second higher divergence from a fib is a very strong look for us, followed by trigger lines rolling, and then this inside of this circle is where you as a new user are going to be absolutely killing it. This is where the money's made right here. And again, having the understanding that it was a great bottom first, followed by a weak top, followed by a better bottom with a higher divergence, is going to give you ultimate confidence in taking this long trade. And not only taking the long trade, understanding that because the way the chart is configured, edge of fibs, weak top, better bottom, you're going to get a bigger trade. You're going to make more profit. And this one, just to look at it, rough numbers, from 58 up to 78, that's 20 S&P points. I mean, that's $1,000 on one contract. Considering it's only $500 to trade an S&P contract, that's 200% on margin with one move. You're going to get a lot of moves in the day, but there are times where we get much larger moves. So let's back out and look at that same area. Right? This is the 5-1 chart of the same thing we were just looking at. So remember we talked about the 5-1 chart can cause a pivot from nowhere to happen. And this is where it's really important to see the multiple divergences and the charts changing colors and the trigger lines rolling over so you don't stay overly committed to long trades, right? With a great bottom, you may be more assertive, you may take a trade. It doesn't matter. That's not what we're talking about. We're talking about managing out of a long thought. And at the same time we're managing out, we're also saying our 13-2 chart is a weak top. Which means that eventually, this is where the second higher divergence happened on the 13-2 chart. It was also divergence on the low on our smaller chart. And then ultimately, this was the pullback, either here or here, that generated that 5-1 trend trade rules being true, that gave you as a bare bones minimum from here up to here. I mean, that's bare bones minimum, but you can see there was never a termination condition on the 5-1 chart all the way up. So if we have one, we have to respect it. And if we don't have one, we can hang on for a little more money, right? And again, we tell you guys to trade for set smaller profit targets first, but that's going to be out the window really quick once you realize you have the proper contextual, read of whether it's a good bottom, bad top, better bottom, better look, right? good bottom, be more assertive, manage your trade with a weak top, recognizing that we have fib support, recognizing that we have strong triggers, and you end up getting your trend trade. And again, this is where if you don't have this understanding of strong bottoms and weak tops, or weak, vice versa, you look at all of this, and as a new user, you're like, what the heck am I supposed to do with all this information? So this, defining the good tops or bottoms is going to help you with what you should be reading on your chart. I put in this slide. This is from the December of 2020, long time ago, but it was in the same tops and bottoms video I did my old one. So this is kind of modernizing the same video, just a little more current context. But again, look, this is what I wrote years ago and many years before that, but it's the same thing over and over and over. This is not new concepts. The edges of fibs get reached. Did the triggers roll up? No. So we're not going long. It breaks, and then we have to classify the bottom. Bad bottom, take continuations to the short side. And then we hit fibs with divergence, and we stop going short. Right? And then ultimately we have a double divergence pivot stop out of a cyan line at fibs with the small triggers above, and we have a great bottom, and you know what should happen next. We're going up, and maybe for quite some time. So what happens is you start thinking about the strength of the bottom, and you're saying these areas are probably going to break because we've had such a great bottom. This is another, this is from the same contract, the December 2020. For a long time we've been saying this, but it's the same relationship that you're going to get when you start reading your chart. So let's start at the top. Okay. And I want you to look at your trigger lines, and we have red fibs. So that's our spot. And we have strong triggers into the fibs, and it makes a top, but it's not a great top. And again, the stronger the triggers are the first time, usually the market's going to bounce up one more time. Now, we're not going long, but we have to respect the fact that the market may bounce up again because of the strength of the triggers over here on the left side. As we reach this same Fibonacci area, now the small triggers are located below the large triggers, and we have a red background, and we make a divergence. So now we call, again, this is my picture from years ago. You can go find the video, but it's a very strong top with lower, weaker triggers plus divergence, high probability shorts. And in that video, we discuss the strength of the trigger lines after this happens and taking short trades. And, this is where new users of our software get tripped up on rule number 2. Let me show it to you. Rule number 2 says, right, do not trade into any Fibonacci areas that are expected to hold. Now, as a new user, you're like, okay, any blue line is good enough. It might hold. Well, expected to hold is a different scenario once you have the proper context of the strength of the top or bottom. So let's take a look at it. Because we had strong triggers first, the areas may hold. Mid bands and fibs bounces the market back up. Because we had a weak trigger line and we had divergence from a fib, now we have strong triggers. The mid band's probably going to break. So this no longer becomes a number 2 termination condition in your brain because of the great top. It is not a great top the first time, so this same exact area does make the market go back up. Because we have a very strong top designation, as long as the small and large triggers remain strong, this fib and mid band are going to break, this fib's going to break, and you can end up doing trades into those areas. And again, you can always take your first profit target and get to break even. And you can always take the trade and take your first profit target and get to break even. And then ultimately it breaks. And why does it break? And again, that's, we spent many, last 25 years going through why, right? Why did this one hold? Why did this one break? And it comes down to, number one, did the Fibonacci hold? And then number two, what was the condition of the indicators when it held? And then what is the condition of the trigger lines as we get to these areas, and what can we expect? And you'll see, you'll end up, not being nervous about taking a short because of rule number two. You'll probably be nervous in the beginning, but that's okay. Just take it anyway and see what happens. This is the key right here. Very strong top first. It's going to change everything that you do when you're looking at our software. Let's do another one. This is from November 10th of 2020. And again, in this slide, we had talked about Fibonacci areas. And, again, we got to a Fibonacci area. The triggers were not too strong, not too weak. And then ultimately, the mid-band held and pushed the market down one more time. Very, very common. You'll see that in our trigger line section, in our, section number 1. And in the manual, we talk about this exact same pattern. Happens pretty much every day. In this concept, we were talking about the edge of Fibonacci. Because these are fibs from, maybe the 5-1 chart, 13-2 chart, 21-3 chart. So we plot multiple time frames of fibs on a single chart, which gives us a better view of multiple time frame fibs. You don't have to have them plotted on there. You can just look at the other charts, but just makes it a little bit easier. And if the triggers get, they cross up before you reach the edge of fibs, that's a benefit, that's a really good benefit, because people were willing to buy down here, but they didn't continue. And again, this is where we have the edge of fibs with no triggers below it. And we have a divergence line pivot stop out. And we have a second divergence. This is literally almost every termination condition we have rolled up into one. And this is still not your trade down here. As sexy as that is right there, that's not yours. Your trade, and you'll start to see it, and you'll start going, oh my God, I see it. Look, this is your trade right here. After the good bottom holds, and after the triggers roll with strength, you're going to buy a pullback, and you're going to make a ton of freaking money most of the time. And, look, if you get a great bottom and you get great triggers and you get a great entry area for pullback and you go long and you lose $120, it's okay. Right? That's really trading with the odds. And if you're going to win, 70 or 80% of those, you have to lose 20 or 30%. The trick is make sure that these are the only ones you're doing. That's the secret. Now, you'll start, this is from 2020 as well, but you'll start to see this will go a little bit faster. So strong triggers break fibs, weak bottom, not in the middle of nowhere. And then ultimately we get back to the mid band and we have strong triggers, and you might even take a long trade here, but in the back of your mind, you're going to be thinking about this weak bottom from the middle of nowhere, which is going to make you manage your trade very judiciously if you did take a long. And then you're going to think about the continuation logic that we talked about just a little while ago. Let's take a look at it one more time. Remember this slide where we said weak top, mid bands and fibs, and then the triggers roll over and we can go long, right? So the idea is that the triggers roll over. And we talked about not waiting for all of the triggers to roll before you do a trade, because you're going to miss all the good stuff, right? The big move. So let's go back to that slide. And again, look, the continuation logic applies to every chart, every market, everyone in the whole wide world. Even a 13-2 chart, 21-3 chart, 34.5 chart, a 45-minute chart, a 4-hour chart, a daily chart, doesn't matter. If you have a weak bottom and the mid-band holds, as the small triggers are rolling down again, this is essentially the continuation look on whatever chart this is. So it doesn't have to be, later in your trading career. Any chart that tells you to start going short again, you can start making short trades on your 5-1 chart when your small triggers are down in a continuation style, all because you knew over here is a weak bottom and that we were supposed to get to the fibs. And you'll hear us say in class sometimes, we call it unfinished business, right? Where the market was going down and it was supposed to get to the fibs, but it didn't, and put in a weak bottom. Usually after they roll over, they're going to make it to the fibs, maybe beyond. So you're going to start to have a real clear understanding of what the market's doing and why it's doing it. Now, prior to your trend trades, right, we're going to focus on your 13.2 chart, your larger chart, right? I say 13.2, but eventually you're going to try other charts and see what happens. So whatever your large chart is, focus on that at the areas, check for the location and strength of the trigger lines. After all the trigger lines roll over, you can also anticipate that the first areas in the way are going to be able to break, right? Which we just went through. If a weak top or bottom is true, you're also going to train yourself to be quick with the management on any trend trades you have going the other way. You're also going to take a weak top or bottom and you're going to start thinking about continuation trades after that top or bottom or something, as you add in charts, you'll see a lot of our users will use a 21.3 chart. What they're doing is they're looking for strong triggers on the 21.3 chart to tell them that the mid band on the 13.2 is going to hold after a weak top or bottom on the 13.2 chart. And I put this in here, I've seen many people wreck themselves. Never, ever, ever counter trend trade against strong triggers. And what I mean by that is just because you get to a termination condition or a Fibonacci area, don't assume it might turn and try to jump in front of the reversal so you can be first, right? You don't have to be first. You have to wait for it to hold and the triggers to not be strong against you. You want them to be strong for you. And that's the secret. And you'll start confidently reading all of your charts. You'll be able to take charts, for example, this is an overwhelming, it's an old chart. It's a 14.2 chart. It's not even a 13.2 chart, but it would, for a new user, this is an overwhelming amount of information to digest. When they pull up a chart, it's like, oh my God, what am I supposed to do? But as you work your way from the left side of the chart going forward, it becomes very obvious. So initially, not a great bottom, followed by a great bottom with divergence from fibs, followed by a really nice move to the upside. So find your long trades in there. And then eventually we have the edge of fibs and we have triggers rolling for shorts and we get to the mid band. And then eventually the mid band breaks and now we have breakouts, so we know we're in a strong move, so we can keep going short. And eventually we get back to the target areas and we put in another bottom that we can say is not great, right? So it's not a great bottom. Mid band will probably hold at fibs, which it does. And then eventually we make a great bottom with fibs, the edge of fibs, one-to-ones, divergence, higher pivots, and then look at what the market does. It goes up really, really, really strong. So because we're defining whether it's a great bottom or, not a great bottom, not a great bottom, great bottom, or good top, right, that leads to a short to the mid band, and then a breakout, which is great, that leads to more trades down, and then not great, great. And again, it really will, you know, the overwhelming amount of information will be able to be digested very, very easily for you. And you'll be able to look at any chart and say, you know, this is a great termination condition for us. It's a very good area, but the triggers never go strong to the downside. So what normally happens, mid-band and fibs usually makes it go up again. And then ultimately we get divergence from the edge of fibs. And then we get the triggers to roll, followed by not a great bottom, followed by mid-band and fibs holding again, followed by breakouts, followed by continuation. See how, you know, again, me doing it is pretty easy because I've done it a million times, but you'll start to feel it just as comfortable in reading your charts. And as you go through them, you'll be able to look at it and say, okay, this is great for going long. If a termination condition happens, you know, the market will sometimes go lower and then you have to take a continuation long. And you'll also be able to say, hey, we reached Fibonacci and my triggers are weak and we had divergence, so we're probably going to keep going lower this time. And, you know, ultimately, you know, everybody's going to ask the question, can I use this on a larger chart? I want to trade my stocks. I want to day trade stock options. I want to do different things. And again, in the, you know, large chart swing trading section, the answer is yes, but, and again, I want you to read this. You can read it later, but it's imperative that you have an overwhelming confidence in your ability to not only read the charts, but do entries and exits based on what the charts are telling you accurately. And if you learn our method on a day trading 13-2-5-1 chart, you'll be able to take that confidence to some larger charts. And again, I'll put together a larger chart. This is Tesla. When did I take this? June 16, 2022. They've been killing the market. So, but again, I want you to look at your daily chart. This is a daily chart. And we had shorts because everything was going down, and then we broke a fib, and then you had more shorts. And, you know, we're talking like, I mean, the first one was way up here above 1,000. But look, if you right here bought puts for somewhere down here, I mean, that's literally a $300 move in Tesla. That's pretty big. Ultimately, look, daily chart gets to fibs that hold, but all the triggers haven't rolled up. So they're not quite done yet. All right, so we're not looking for longs, but we know that we're getting close to a potential bottom. So maybe you know, build a 4-hour chart or a 30-minute chart or something like that. But even this is a 4-hour chart. Just reading it right now, you can see we had a pivot stop out. The triggers are rolling. They're strong down. So 700 is probably going to hold, and you can see so far it's been holding, and I don't know where it went down to, but it did go down a little further. So maybe we put in a bottom, but there's a lot of work that needs to be done with trigger lines rolling before you can, you know, have fun going long in Tesla. It's guessing and gambling going long without everything going up. So again, you can use this on other charts, but you have to have confidence in the method first. So learn it on day trading. And again, we talked about this, you know, you have to have a good contextual understanding of what the market is telling you. And when we say the words in the classroom and in the manual, day trading is 90% chart reading, 10% trading. So your focus on chart reading is going to set you apart from anything else you've ever done before Nexgen. Start your analysis on the large charts from the prior swing or two, and only look for trades after a strong top or bottom initially, especially while you're new. Probably going to take you through the first 3 or 4 months of your use of our software. Then you can add on some of those other little trades like continuation entries and things like that. You can watch them, and you'll just get more comfortable as more time goes by, is all I'm trying to say. Do not take trades that are counter to the strong triggers on the 21 chart. They will fail on you. So just because you get to an area, don't get all cute trying to go the other way against strong 13-2 triggers. We talked about it once, but it's always important to reiterate. Now, finally, the most important thing you can do for yourself is go into our classroom, even if you can only be in there for 15 minutes, and say, hey, take a look at the trades that I've done on simulator. You will not have, and again, you can learn a lot from going through our material, but it's that last little bit to just make sure that you're doing it right. As day traders, we have a tendency to think we're smarter than we are. Everybody's guilty of that. And most of us who are men, 90% of men and 50% of women don't read the directions before they start trading. So if you just take the time to learn how to do it right once, get a little feedback from the educators, which we've also recorded a lot of our classrooms on the YouTube playlist. So if you can't make it in there, you can still get the benefit. Just let us make sure you're doing it right. We want you to make a ton of money with Nexgen. We're very confident that you're going to if you do it properly. I appreciate your time, and I look forward to you trading our software.